Welcome to the Deep Dive. We're the show that cuts through the jargon in those complex reports, the financial statements. We try to pull out the insights you actually need.
Exactly.
Today, we're digging into Havells India Limited, specifically their unaudited results for the first quarter ending June 30th, 2025, so Q1 FY26.
Right. Fresh off the press, basically.
And our mission here is pretty straightforward. Unpack the main numbers, get the story behind them, and look at the strategy, the surprises, what the company itself is saying.
Yeah, we've gone through the P&L, balance sheet, cash flow, the ratios, segment data.
And listen to the earnings call, too. We're basically trying to give you the shortcut to getting your head around it all.
Get the essence, yeah. What happened, why, and what's next, without you having to read every single line item.
Okay, so let's peel back that first layer, the big picture. How did Havells actually do overall in Q1 compared to last year? Was it like a banner quarter?
Not exactly banner, no. There was a noticeable dip, actually, on both the top and bottom lines. Net revenue came in at Rs 5,438 crores. Now, that's down 6.2% year-on-year from nearly 5,800 crores.
Okay, a 6% drop in revenue. And profit.
Net profit, that saw a bigger drop. It was Rs 352 crores, which is 14.3% lower than the 411 crores they posted in Q1 last year.
Wow, okay, 14.3% down on profit. That's quite a hit. So what was the company's story? Their immediate reason for this?
Well, their summary pointed straight at the weather. They called it a tepid summer this year and contrasted that with a really strong season last year. They said that difference really hit the cooling products hard.
Right, the ACs and coolers. Makes sense.
Yeah. And they also mentioned that, general consumer demand was still pretty subdued. But on the flip side, the industrial and infrastructure side of things kept its momentum.
Okay, so consumer down, industrial holding up. Did they mention anything else, like how they managed the costs?
Oh, yeah, definitely. They highlighted a big focus on cost discipline. They said that helped keep expense growth modest and sort of contain the damage to the net profit from the lower revenue.
The classic cost discipline. We hear that a lot when revenues dip. But how real was it? Can we actually see it in the numbers? Where did they cut, and did it really cushion the blow to margins?
Yeah, you can see some of it. Advertising and sales promotion, for example, they slashed that by 17.4% compared to last year. That's a pretty common lever to pull first.
Okay, cut the ads. But what about other costs?
That's where it gets interesting. There are other SG&A, selling, general, admin costs.
Salaries, rent, that kind of stuff.
Exactly. That actually increased by 8.5%. So
Yeah.
even while cutting ads, other core costs went up. Maybe expansions, maybe new hires, something pushed those up.
Huh. So not quite disciplined across the board then.
Well, maybe discipline where they could be. But the overall impact, EBITDA, so earnings before interest, taxes, depreciation, amortization, basically operating profit.
Got it.
That fell 9.8% year-on-year to 520 crores. And the EBITDA margin slipped a bit, from 9.9% down to 9.6% of revenue.
So margins did get squeezed?
They did. Profit before tax was down 14.1%, very close to the net profit decline. And the net profit margin itself ended at 6.5%, down from 7.1%. So yes, they managed some costs, but that revenue drop was just too significant to fully offset, especially with those other SG&A costs rising. It hints at maybe some deeper cost pressures, something to keep an eye on.
Right. So cost controls helped a bit, but the revenue fall still hurt profitability.
Yeah.
To really get why, I guess we need to break it down segment by segment, right? Which parts of the business drove this?
Absolutely. Let's start with the one they mentioned most, Lloyd Consumer, the cooling products.
Yeah.
Revenue there was 12,262 crores. That's a huge drop, 34.4% down year-on-year from over 9,100 crores.
Wow, 34% down. That explains a lot. And profitability?
Actually swung to a loss. A loss of Rs 20 crores for the segment, compared to a profit of 67 crores last year.
Ouch. A loss in Lloyd.
Yeah. And the context, as we said, was that weak summer versus a strong one last year. Management was pretty clear. They see this as transitory, seasonal, not something wrong with the Lloyd brand itself.
Hey, transitory is the word they used. But, swinging to a loss.
Mm-hmm.
Are there any maybe hidden risks there beyond just the weather? They keep saying Lloyd is a long-term thing.
It's a fair point. They do frame Lloyd as a medium to long-term play. They talk about focusing on margin improvements through efficiency and better pricing, even while they keep investing in the brand and pushing into more markets.
Right.
But the potential, maybe red flag, inventory. It sounds like channel inventory, what's sitting with dealers and retailers for ACs, fans, coolers, is high. And Havells' own inventory is high, too.
Inventory overhang, that can be tricky.
It can. Management sounded confident and said we'll get readjusted over the next couple of quarters. But, managing that pile up is going to be pretty critical for them.
Confident it will readjust. Heard that one before. But seriously, with inventory that high, what are they actually doing about it? How do they make sure it clears?
Well, they mentioned being fairly flexible with our supply chain, said they have better adjustment capabilities now. I think the expectation is really, hoping for a more normal summer next time. Plus, their ongoing market expansion efforts should help soak up that excess stock eventually.
Okay, fingers crossed for them on that front. So Lloyd was the big drag. What about the other segments? Any bright spots?
Oh, definitely. Cables and wires had a fantastic quarter, actually. Revenue hit Rs 1,933 crores. That's up a really strong 27.1% year-on-year.
27%, that's huge.
Yeah, and segment profit jumped too, to 243 crores from 171 crores last year. They put it down to robust volume growth, helped by capacity expansion and just strong demand from industry and infrastructure projects.
So the B2B side is firing.
Seems like it. Management said volume growth was around 21%, with value growth higher at 27%, suggesting maybe some price realization too. They're getting good traction in exports as well.
Interesting.
And their contribution margin in cables and wires was 16.0%. That's basically the profit left after variable costs.
Right, to cover fixed costs and make profit.
Exactly. And 16% is actually above their target range of 14–15%. So really strong performance there. Plus, they're doubling down, investing more to expand capacity, especially in underground cables.
Okay, so cables and wires looks very solid. What about electrical consumer durables? ECD, fans and things.
Right, ECD. Revenue there was Artis 906 crores. That was down 14.1% year-on-year.
Down 14%, so also hit by the summer.
Yeah, exactly the same story.
Yeah.
Unseasonal rains and shorter summer season impacted demand for fans and air coolers. Very similar to Lloyd's situation. Management did say that while the overall segment took a hit because summer products like room coolers dropped sharply, the underlying contribution margins on individual products, fans, water heaters, small appliances are actually improving.
Oh, that's interesting. So efficiency gains even with lower sales.
Seems like it. And they believe they actually held or maybe even gained a bit of market share in fans despite the tough quarter, which is, something positive to take away.
Yeah, holding share in a down market is key. Okay, it really does sound like the weather just dominated this quarter, doesn't it? How did lighting and switchgear fare?
It really did cast a shadow. So lighting and fixtures. Revenue was 374 crores, down just slightly, 3.1% year-on-year. The reason they gave for that small decline was about 10% year-on-year price deflation in LEDs. So prices are still falling there.
The LED price wars continue.
Sort of, but management did say prices seem to be plateauing sequentially. Maybe the worst is over. And their strategy there is clear. Keep investing in the high-end premium stuff, the solution-oriented products. That's how they maintain what they call industry-leading margins. They sounded pretty positive about lighting long-term, trying to avoid that race to the bottom on price.
Makes sense. And switchgear.
Switchgear saw decent growth. Revenue was 630 crores, up 9.3% year-on-year. The contribution margin was 37.2%, which is strong, though slightly down from 38.7% last year.
Why the slight dip in margin there?
Management put it down to just fluctuations in product mix, maybe more exports or more project business in the quarter, which can sometimes carry slightly different margins. But they reiterated their target contribution margin is still 38–40%, and they feel they're holding their own against tough competition. It's like a core, steady business for them.
Okay, so we've seen the numbers, the segment ups and downs. But what about the bigger picture, the strategic moves? What did Havells signal this quarter about where they're headed long term? Any big bets?
Oh, yeah. One very significant move, the investment in Goldie Solar.
Goldie Solar, right. Tell me more about that.
They invested 600 crores. That gets them a 9.09% strategic minority stake through a mix of equity and convertible shares. Goldie makes solar modules, inverters. Havells already plays in the solar space a bit.
So this is doubling down on renewables.
Exactly. The rationale was explicitly to accelerate growth in the renewable sector. Management talked about renewables being a big future growth possibility, and it fits perfectly with the government's Made in India push.
Makes strategic sense.
And Goldie is apparently looking at backward integration too into solar cells, maybe even battery storage down the line. Havells has big ambitions here. Their own solar business was maybe 400 and 500 crores last year. They're targeting over 1,500 crores in the next couple of years from this whole ecosystem.
1,500 crores. That's a huge jump.
It is. And they also see it as a way to pull through sales of their other products, right? Cables, switchgear needed for these solar projects. It's quite a clever synergy play.
Yeah, that Goldie Solar investment definitely signals a major long-term bet. Were there other big strategic things happening, other investments?
Yes, a couple more key things. They confirmed continued capacity building, specifically committing another 340 plus crores for the cables and wires segment.
Ah, feeding the growth we saw there.
Precisely. They want to double their underground cable capacity between FY24 and FY27. Shows real confidence in that industrial demand continuing.
Okay, what else?
They're also really pushing on expanding their rural market presence. Rural sales are still smallish, maybe 5–6% of consumer revenue, but they said it's growing faster than urban.
Interesting. How are they tackling that?
Things like opening branded stores, even in small towns of 5,000, 10,000 people, expanding the product range for rural markets, pumps, their HS brand stuff, and Lloyd is coming soon too. They stress it's a calibrated strategy, not just, dumping stock. They want to ensure the market can actually absorb it. Their Rio brand, apparently, already gets about a quarter of its business from rural areas, so they have some proof of concept.
So a careful, steady push into rural.
Exactly. And lastly, just reinforcing that focus on cost discipline and operational efficiency. We talked about the numbers, but strategically, they see it as crucial for improving margins, especially when revenue is dropping. Management talked about making readjustments in expenses, shifting resources towards growth areas like rural, projects, modern retail. It's about spending smarter, basically.
Okay, strategy seems focused on growth areas and efficiency. We've hit the P&L, the segments, the strategy. What about the overall financial health? Balance sheet, key ratios, how stable do they look?
Right, the balance sheet. Total assets actually dipped slightly between March and June 2025 from about 13,775 crores down to 13,226 crores, mostly because cash and trade receivables went down. But that was partly offset by the big 600 crore Goldie Solar investment showing up as an asset instead of cash.
Makes sense. And inventory, we touched on that being high.
Yeah, and interloads are definitely worth watching. Overall inventory went up from about 4,007 crores in March to 4,186 crores in June. And they directly linked that increase to lower than planned sales in Lloyd. That tepid summer again.
So the inventory build is real.
It is. It was a big topic on the earnings call, apparently. Management acknowledged it's high, but again expressed confidence they can manage it down. They also mentioned a temporary buildup in wires inventory, but expect that to clear quickly.
Okay. Inventory management, always that balancing act, isn't it? Between having enough stock and getting caught with too much. What else on the balance sheet?
Let's see. Working capital efficiency. Trade receivables money owed to them decreased quite a bit, from over 250 crores down to 931 crores.
Less money tied up in receivables? That's good.
It is. And creditor days, how long they take to pay their suppliers, that reduced significantly, from 57 days last year to 44 days this Q1. Management said that wasn't really a change in payment terms, though. More just a reflection of lighter manufacturing activity in the quarter, meaning less purchasing overall.
Ah, okay. Context matters there. Liquidity.
Looks decent. The current ratio improved slightly from 1.7 to 1.8, so comfortable ability to meet short-term obligations.
Good. And the profitability ratios, year on year. We know margins dipped, but what about returns?
Right, the profitability ratios. OPM, the operating margin based on EBITDA, dipped slightly, as we said, 9.9% to 9.6%. But maybe more telling are the return metrics. Return on equity, ROE, profit generated for shareholders, and return on capital employed, ROCE, overall capital efficiency, both saw noticeable declines.
How much?
ROE went from 19.3% down to 17.6% on a trailing 12-month basis, and ROCE dropped from 25.9% to 23.7%.
Okay, so efficiency took a bit of a knock this quarter. Understandable given the revenue pressure, but still something to track.
Definitely. Those are key indicators of how effectively they're using their resources.
So pulling it all together, the tough quarter, the strategic bets, the balance sheet numbers.
Yeah.
What's the vibe from management looking forward? Are they sounding worried, confident?
They're definitely framing Q1 as transitory, really hammering that seasonal impact point, especially for Lloyd. They express clear confidence in their ability to drive revenue growth and margin improvements over the coming quarters. They pointed to that supply chain flexibility and better adjustment capabilities for handling the inventory situation we discussed.
Okay.
And they seem quite positive about demand, picking up from real estate projects, reaching the finishing stages, needing wires, switches, lights. They see that as a tailwind coming soon.
So construction finishing up should help.
Yeah. And overall consumer demand. While it was weak, They're hopeful it will pick up, hopefully, in the second half of the year, maybe driven by a good festive season. Cautiously optimistic, maybe?
Okay, cautiously optimistic seems fair. So, wrapping this up, what does this all mean for you, the listener, trying to understand Havells right now?
Well, I think the key takeaway is that despite a really challenging Q1, driven mostly by that weak summer hitting cooling products hard, Howells showed some agility. They managed costs where they could, even if overall profit fell. Maybe more importantly, they didn't stop investing for the future. That big Goldie solar bet, the continued expansion in cables and wires, the steady push into rural markets, those are all long-term plays happening, despite the short-term pain.
So, managing the present while building the future.
Exactly. It highlights this tension, right? They're tightening the belt on things like advertising now, but making these huge multi-year investments simultaneously. How well they balance that staying nimble day to day while executing these big structural shifts. That's really the core thing to watch.
Yeah, that balancing act is crucial, and it really does raise a bigger question, doesn't it?
It does. It makes you think. How does a large, diversified company like Havells truly navigate these kinds of sharp short-term shocks, like a bad summer season hitting a key segment, while at the same time pouring hundreds of crores into foundational long-term bets like renewables or massive capacity expansions? How do those immediate transient impacts weigh against their commitment to these deeper structural changes in their business and market reach? And what do this quarter's actions really tell us about their resilience and ultimately their growth path in India's economy going forward? It's a fascinating dynamic to consider.